Wanted to jump in and do a pretty deep dive view of what happened on Friday with the employment numbers. Employment data came out Friday, non farm payrolls, unemployment rate, and I wanted to break everything down so you had a better idea as to what I'm looking at. What I see is the Federal Reserve is more than likely not going to be in a rush to lower interest rates. And on Friday, what was a 85% chance based on market participation in the futures market for a drop in rates in March dropped to 50%. So the market kind of believes this as well. The bond market, of course, has gotten ahead of itself. Yields has moved higher, back up above 4.05% for the close on Friday. What we're looking at now is probably a little higher, a little longer. We'll probably see interest rates falling at some point, but the real question becomes, is this a soft landing or what I've described as a touch and go? Let's break down the employment data numbers so you can see what I'm looking at and what I think will happen in the bond markets, which will affect the stock market in this today's stock market review. Let's jump in. If you're just finding my channel for the first time, thanks very much for stopping by. This is a breakaway channel. I just launched it a couple months ago, growing quite nicely. First and foremost, I am an economist, and I break down the economy, and then I look to see how that applies to the stock market. Next, I'm a value investor, and so I approach everything from that perspective. How's the consumer doing, which is 70% of the economy, pushing or pulling down the stock market? And how will that affect individual stocks? If you're looking for written analysis on this, make sure to hit the links down below for links to my website. Here we're looking at, so what I do is the select sector ETFs. I've broken down, what I did was I broke down each sector, updated everything over the holiday break. One stock, future earnings per share, not weighted the way the each individual stock is weighted. I just look at one stock and ask the question, okay, from this perspective, one stock, what kind of yield can I get considering current price today, future earnings per share over the next 4 quarters? As you can see, technology, of course, well over priced. Actually, it's pretty close, 3.35. We did see some movements down. There are only a few stocks that are overvalued, that roughly speaking, the technology sector is kind of balanced. Beyond that, however, a lot of other stocks are significantly undervalued. And energy, of course, being one of them. Those stocks have sold off because of higher interest rates, which gives yield, a whopping 10%. But let's take a look at employment numbers, because this is what I'm really focusing on right now, because this will drive interest rates in the future. Here we quick look at non-farm payrolls. This is the number we got on Friday, and as you can see, a little more than expected. We have seen some kind of narrowing in new job creation. This was kind of a bit of a surprise. I think most economists were looking for about 100,000. We got like 216 or something like that. But this is the numbers that I really wanted to focus on. Civilian labor force. What is a civilian labor force, and how do they calculate unemployment rate? Civilian labor force is those individuals in a certain age group that are either employed or actively seeking employment. If you've not been employed for some period of time, and I think it's something like 6 to 9 months, they don't count you as wanting a job. They figure you could have gotten a job at McDonald's. So your stay-at-home girlfriends that we're seeing on TikTok that are having their moment right now, they don't want jobs. They want to stay at home and be girlfriends. They are not counted in the civilian labor force. So you take the civilian labor force and you ask the question, how many of them are employed or unemployed? This is the number that it's unemployed. You saw a decline, a slight decline in civilian labor force. Number of unemployed remained the same. This is pulling the unemployment rate downward somewhat. So when we see 3.7%, if you actually look at the decimal points and you kind of break things down, individuals who have not been able to get rehired are staying that way. Look at initial claims, look at continuing claims. Initial claims are pretty flatline. Continuing claims kind of moving up a little bit and staying there, reiterating that if you lost your job, you probably don't want one. So the civilian labor force, if this becomes a trend, is shrinking very modestly, which gives the perception that at 3.7%, the economy is actually barreling forward. What it isn't necessarily so much that we're seeing a very strong economy as much as we're seeing a slight shrink in the civilian labor force, which pulls unemployment rate downward. In the meantime, Treasury yields. Now, this is a Friday snapshot. This is over the weekend. Closing at 4.05%. Today's actually Sunday, and I think I saw moves slightly lower in the 10-year Treasury. And this is the U.S. 10-year Treasury. I default to the 10-year. It's the benchmark investment rate. My thinking, bottom line, the Federal Reserve does not have any kind of information to either raise or lower interest rates from this point. If they were to lower interest rates, what would happen is they may be too accommodative. The employment situation increases, and that could pressure price pressures. Inflation, at the end of the day, isn't there yet. So it's sort of, I don't want to call it the Goldilocks economy, what they were calling it back in the late 1990s, but it kind of is. This interest rate level is the Goldilocks level. If the Federal Reserve were to push it up a little more, that could be too restrictive. If the Federal Reserve were to pull it downward, it could be too accommodative. So the information we have today is that the interest rates are probably where they need to be for now. We'll get more data this week. We'll get more data next week. It takes some 3, 6, 9, 12 months for the interest rate movements to work in. So I really feel like the Treasury yields have gotten ahead of themselves with the push lower for the 10-year down below the 4% level. That's probably going to moderate. We'll probably see price yield levels between, say, 4.25, somewhere in that range. In the meantime, S&P 500, it's kind of a two-handed economist situation. On the one hand, interest rates are probably going to remain a little higher. But at 4%, that's neither too restrictive nor too accommodative. Those that may have lost or became unemployed aren't exactly the biggest contributors to the overall economy. So from one perspective, you could look at the interest rate levels and the S&P 500, of course, and say, we're about where we need to be. And this economy will move forward at a pace, not too robust, not too restrictive. And that's where we are. I think the interest rates, the drop we saw all through, we pushed above 5% in the 10-year yield, dropping back down below 4%. I think 4 to 4.25 may be appropriate for the first 3 months of this year. And as long as inflation doesn't start creeping upward, we could stay there for some period of time. Then the Federal Reserve could move should they need to. But right now, interest rates are where they need to be, and it's not too bothersome to the economy. The S&P 500, it's about where it needs to be. Technology stocks, as I showed earlier, a little overvalued, whereas the rest of the stock market is undervalued. So you may see some repositioning moving in certain stocks, but overall, this is an economy that's going to push forward. Will we get more inflation? Will inflation drop to the 2% level in a rapid enough pace at this level with interest rates? I still don't believe so long term. I think the Federal Reserve, at the very least, needs to leave interest rates higher for longer. This will play out over a few months. Make sure to hit that like and follow button as I break down these kind of data points to show you what's actually happening. And if you want the written analysis, hit the links down below to my website. We'll see you in the next video.